Is the once mighty economic powerhouse of the United Kingdom now teetering on the brink of a serious crisis? The United Kingdom is now facing economic challenges and declining influence due to social, political, and financial issues, which is disheartening because it is not inevitable. A thriving economy is easier to sustain, characterized by a strong currency, investment attraction, low borrowing rates, and long-term political stability. Conversely, a stagnating or shrinking economy experiences undesirable consequences such as a weakened currency, difficulty in borrowing, decreased investment, and short-term policy decisions driven by electoral promises. The current state of the UK reflects a diminished global influence, with economic concentration in unproductive industries leading to issues like poverty and regional inequality. The nation, once an industrial revolution leader, is grappling with real challenges. However, the severity of these issues might be underestimated given the emergence of a two-speed economy, marked by extreme wealth in London and economic decline elsewhere. While the national averages may appear stable, the standard of living for most UK residents is regressing. The key concern is the potential indifference of policymakers to reverse this trend, resulting in continued prosperity for those in London's global industries at the expense of the rest of the country. This situation raises intriguing questions about the definition of economic success in the modern era. The sudden decline of the UK prompts inquiries into whether London's growth has adversely affected the rest of the nation and whether it is possible to reverse these issues now that they have taken hold after centuries of dominance. Italy and Greece, both facing economic stagnation since the mid-2000s, serve as comparisons to the challenges currently confronting the United Kingdom. While the UK situation is not as dire as those of these countries, the difficulties it faces are distinct and potentially more complex. A significant issue lies in a crisis of confidence, a crucial factor in national economies. The UK's economic troubles, though on a gradual decline from its peak as a dominant colonial power, can be traced back to September 16, 1992, known as Black Wednesday. Prior to this event, the UK was considered one of the world's most stable and reliable economies for trade, finance, and investment. The pound held the status of the world's second most used global currency. 2 years before Black Wednesday, the UK entered into the exchange rate mechanism, akin to the early version of the euro. This agreement linked major European currencies with pre-agreed exchange rate ranges. Central banks would intervene if a country's exchange rate with another member deviated from the agreed range. While theoretically sensible, the process was costly, requiring substantial reserves and complicating currency management. The exchange rate mechanism, or ERM, aimed to facilitate cross-border trade and investment by mitigating exchange rate risks. However, the UK initially refrained from joining this scheme when it was introduced by the European Economic Community in 1979, the precursor to the European Union. It took the UK 11 years to join the exchange rate mechanism due to internal debates about the advantages and risks of indirectly pegging their globally dominant currency to Europe. Unfortunately, their entry in 1990 coincided with the Soviet Union's collapse and the reunification of East and West Germany. Germany, facing economic challenges in the East, raised interest rates to attract foreign investors. This unconventional move aimed to generate funds for the East development without risking inflation, a concern rooted in Germany's historical hyperinflation. The ERM tied the values of currencies together, and the high interest rates in Germany attracted global investors, including those from the UK. The British pound's value wanted to decrease while the Deutschmark wanted to rise, but ERM rules prevented the UK from allowing this natural adjustment. To artificially maintain the pound's value, the UK sold large reserves of foreign currencies and raised interest rates, contrary to what would have been beneficial for its own struggling economy. Investors suspected the inevitable failure of these interventions, leading them to convert more money into German Deutschmarks. The ERM eventually collapsed, marked by desperate attempts by the Bank of England to stabilize the foreign exchange rate. On collapse day, interest rates of the UK fluctuated from 10 to 15%, only to be lowered back to 12%, highlighting the challenges faced in maintaining stability within a day. In the short term, both the UK and the rest of Europe experienced negative consequences, but the long-term impact on the United Kingdom went beyond immediate harm. It raised significant doubts about the country's effective management. Following severe blows from the global financial crisis and collateral damage from the Eurozone crisis, the UK underwent an uncertain separation from the EU. Presently, it is often recognized for a revolving door of prime ministers, though as somebody not from the UK, I'll refrain from commenting on that matter. Consequently, the lack of certainty regarding the UK's future has made it a risky prospect for investments, trade deals, and various engagements. The country, once renowned for its consistency, now faces skepticism. While it remains more stable than certain nations, such as Somalia, the UK's reliance on the financial industry, particularly centered in London, has become pronounced. While this has benefited the city, it has not translated into widespread advantages for the entire country. Unlike financial hubs like New York, a significant portion of the funds flowing into London is directed towards global financial investments rather than domestic enterprises and projects. This trend reflects the city's attractiveness for international business due to its leniency rather than the markets it offers access to. London remains the second largest financial hub globally. However, the financial activities conducted there are, in many aspects, adversely affecting the overall well-being of the country. Over the past century, the British pound has experienced a gradual and steady decline compared to other global currencies. Despite this, some argue that its current valuation is inflated, primarily due to its extensive use in the financial sector of London. This situation has negatively impacted domestic British industries, making it challenging for them to compete with counterparts in the EU and other emerging global competitors who benefit from more favorable trade agreements. Once a leader in industrialization, the UK now faces challenges such as aging infrastructure, declining education standards, and limited adoption of technology. Consequently, the productivity of the workforce has decreased, making them less competitive on the global stage and leading to lower compensation. High-skilled workers in the UK are finding more lucrative opportunities in countries like the USA, Canada, Australia, and various Asian financial centers. This dynamic has created a paradoxical situation where the UK attracts people from less developed economies seeking a better life, while simultaneously witnessing a significant number of its own population leaving for superior opportunities elsewhere. Although the current influx of people to the UK exceeds the outflow, the country has been losing a substantial number of highly skilled workers annually since 2007. If this trend persists, the UK could face a declining population and a significant loss of its most productive workforce. This prevailing negative perspective has diminished the attractiveness of the UK for investments, business ventures, and career pursuits. Typically, advanced high-income countries, including the still relatively affluent UK, possess a final line of defense against such challenges. This involves relying on their wealthy citizens to compensate for the lack of foreign investment and address issues like national debt. For instance, Japan, despite having the highest debt-to-GDP ratio globally, doesn't raise significant concerns among economists because a substantial portion of their debt is owed at low interest rates to their own population. Similarly, the UK has a considerable number of affluent residents who could potentially infuse essential investments into the economy. However, akin to foreign investors, these wealthy individuals are opting to invest their capital into other countries with more predictable futures. The disparity between foreign direct investment outflows and inflows in the UK has reached unprecedented levels since the global financial crisis. While this may appear theoretical, its tangible consequences are palpable in the UK, where the nation grapples with regional poverty, marked by a growing population unable to afford living in their own country. Unfortunately, if these challenges persist, they are likely to exacerbate one another, reminiscent of the situation in 1992, as increasingly desperate measures are taken to salvage the deteriorating situation. Well, that's it for today's video. Hey, make sure that you like the video, and please share your views in the comments section with us. Subscribe to the channel so you stay updated, and don't forget to hit the bell icon so you never miss an update. Thanks for watching today's video, and we'll see you in the next one.